Today we are analyzing Healthpeak Properties, ticker PEAK. Over the next few minutes, I'll discuss my thoughts with the valuation of this company and its business quality. We have a market cap of $11.5 billion, enterprise value of $17.3 billion. So you see almost $6 billion in net debt on this business, which is over a third of the overall enterprise value. That is a significant amount of leverage because you can see it's over half of the market cap. This is an equity real estate investment trust. So when you're investing in real estate, a lot of leverage is something to be expected. But of course, this is still a very high number. Healthpeak Properties is a fully integrated REIT and S&P 500 company. They own and develop high-quality real estate in the three private pay healthcare asset classes of life sciences, medical offices, CCRC. So private pay seems like a key word here. Private pay should mean that they're not really working through government pay type systems. Maybe they have a little bit more pricing power that way. We'll have to see. So we pair a deep understanding of the real estate market with a strong vision for long-term growth. Beta of 0.881. This is a little bit significant because it's about 12% less than the average S&P 500 company. The lower the beta, that tends to be a positive sign for less volatility in the stock, and a lower volatility stock tends to mean it's a relatively high quality business. Not always, but that is one positive sign. You can instantly see here on this return on invested capital chart that they have 1 year of losses in the last 20 years, which is a good sign. I really like to see 19 or 20 years of profitability over a 20-year period for the marker of a high quality business, and you can see they lost money just in 2015. Now, one thing I do see here is they have some fairly cyclical returns. You can see kind of trending up, trending down, trending up, trending down, trending up, trending down. And so there is a decent amount of cyclicality in the business. I do observe that. Cyclicality is a negative from a business quality standpoint. The less cyclical, the better, because it's easier to predict the future. Second thing I see here is you can see they're basically hovering around this 5% line. In fact, a lot of times they're actually below the 5% line. They've been below it many years. They've only been above it, looks like 4 years in the last 20. So that's a pretty low return. You also see just this 10% line return on invested capital. They never really cross it. 10% is my minimum target of what I want to see as a return on invested capital for me as a shareholder. So despite the fact that they have 19 straight years of profitability, this is going to be more in my bucket of an average business so far. They have a return on equity here of 7.1%, also below my target of 15%. And so you can see despite them having leverage, which is turning this 3.4% return on invested capital into a 7% return on equity, you're really not hitting the double digits. It's very difficult as a long-term shareholder of a business to get double-digit returns if you're not earning double-digit returns on equity or double-digit returns on invested capital. So those are metrics that I look for. And for me, I need double-digit returns. If you don't need double-digit returns, then this is a possibility where it could still be super attractive. One thing I do want to highlight though is there is a big gap here between pre-tax income of 17% and free cash flow of 55%. So you can mean that's almost triple the number here in terms of your free cash flow. So if you were to triple it and just say, okay, what is my free cash flow return on capital? And then now we're closer to that 10% number. So of course, real estate is a free cash flow play. So for those who are highly focused on that free cash flow number, you can see some path here to 10% returns, but not a lot above that. And that is still a concern for me. I'd really like to be substantially above that. You can also see that there's a very small gap here between gross profit and free cash flow. So there's not a lot of room for continuing operating leverage in this business, which is one of the things I look for the potential for outperformance. If I can find operating leverage, then you have the ability for small revenue growth to turn into high earnings growth, and we don't really see that here. Price to earnings ratio of 21 is quite high. Price to sales of 5.5 is certainly not low, and you have a lot of high EV numbers here. Even EV to free cash flow is around 20. So for those using the free cash flow numbers, you still have a fairly expensive business here. This is not a cheap business by any means. So you're looking like a cheap business, maybe average quality. This is especially compounded as a potential problem when you really look at these 10-year CAGRs on revenue, free cash flow, and EPS. Free cash flow is lower today than it was a decade ago, and revenue is basically flat, up maybe 1% over the course of the decade. But when we just sit down to these numbers, in 2013, you can see $2.1 billion in revenue. At the end of 2022, you had $2.06 billion in revenue. So again, you're lower in revenue than you were a decade ago. Now, If there were spin-offs, acquisitions, M&A can really play a big role in numbers like this. And so you have to, take that with a grain of salt. There are reasons this could be, if they've been spinning a bunch of assets off, that's a reasonable explanation why you might have flat numbers, but still really good returns. But just on a simple numbers basis, it is concerning for me. The other piece that I'm concerned about is you began the decade with a gross margin of 85%. You ended with 58%. This is a horrendous problem because you can see almost every year they're getting worse and worse on their gross margin. So not only is their revenue not growing, their costs are continuing to grow because their gross profit is crashing. You had $1.8 billion in gross profit and now you have $1.2 billion in gross profit. But the operating profit is even worse because your gross profit number is going down so fast. You're having negative operating leverage because your operating profit looks like it's gone down almost 75%. You used to have an operating margin of 60%. You're now down to 17%. You've gone from $1.2 billion in operating profit down to $357 million in operating profit. So this business is clearly deteriorating, and I am not at all attracted to deteriorating businesses. Likewise, they used to be paying a dividend pretty close to their earnings per share, and now you can see that their dividend exceeds their earnings per share and certainly has substantially exceeded their earnings per share over the last 3 or 4 years. So that is something that I would be concerned about because they're going to continue to have to cut the dividend if the business continues to deteriorate. All of these negative numbers, negative growth, while still at a high price in average business, I'm not feeling very good about this stock right now. It's certainly not being something that's just leaping off the page and saying, hey, this is attractive. If you're learning something, though, if you're finding this interesting and you want to continue to learn more, hit that like button. Don't forget to subscribe and stay tuned because now we're going to go to the income statement, balance sheet, and cash flow statement. So one of the things, of course, we need to understand what's going on with gross profit. Why are gross profit margins getting so bad? And you can see the cost of goods sold is accelerating. It's gone up significantly. Now, it did drop a lot from 2017 to 2018. There was also a big drop in revenue. So I don't know if there was some sort of spinoff here that could play a big role, of course, in your overall performance. But it's not like the shares outstanding changed substantially. Actually, this is actually really bad. So not only have you been getting negative operating leverage, but your shares outstanding have been going up. You've added an additional 80 million, 90 million shares outstanding over the course of the decade. So you have about a 2% per year dilution on top of the fact that the business is getting smaller and smaller. So your net income got cut in half, but your EPS did even worse than that because of this phenomenon. So it's really poor how this is being managed, at least from these numbers, from what I can see on my QuickFS service. So you see SG&A is basically flat, but it's gone up maybe 30% over the course of a decade. Again, some negative operating leverage there. Operating expenses are up significantly, 70-80%. And so again, lots of negative numbers here that I don't like to see in a business like this. This is certainly not very attractive on the income statement side. So look at the balance sheet. Looks like they used to have a bunch of investments, and those investments have gone away. So your assets have gone down. That is a good sign. If you're getting a worse business, at least have less asset intensity. There's not a lot of cash here. Let's look at our debt. You have $5.5 billion in debt. Now, it is good that you have less debt than you began the decade. So, if you're going to get worse and smaller, at least reduce your debt. And they have done that. They've gone, they've cut in $3 billion in debt off that balance sheet. So that is helpful. But again, this is a very cash poor business. $72 million in cash against $5.5 billion in debt. Very little cash kept on this balance sheet. Retained earnings are negative, which if they had a lot of buybacks, that could be attractive, but that's not a good sign, I would think, on this business. This is definitely like a leveraged buyout type system. They're paying out a lot more in dividends than they're earning in net income. So they're taking the dividends from these cash flow, of course, and from what they can do in terms of the business. But overall, there's just not a lot of here that could be exciting. One of the things that I try to do with these is to quickly eliminate companies in about 10 minutes. The faster you can eliminate companies, the faster you can improve your process, the faster you can identify potential stocks to do further research, the better you improve your process. And for me, Healthpeak Properties would fall into the category of quickly eliminate. There's nothing exciting here. This looks like an average business despite having 19 straight years of profitability. They're not hitting double-digit returns. You're paying a pretty above average price for an average business, and the company is not only not growing, but they're shrinking on the earnings line. They're flat on the revenue line. Operating leverage is getting worse because the expenses are growing, so I'm going to pass on Peak. Hope you learned something from this video. Hit that like button. Don't forget to subscribe. You can check out the stocks that passed and hit my watch list in this playlist on the video. And if you want to learn about this software, quickfs.net is what I highly recommend. It is the first link in the description below, and so you can check out how to analyze companies in 10 minutes or less. Thank you for listening. Until next time, stop paying fees, start building wealth.